Hey everybody, have you been investing in stocks for a lot of time and still haven't made too much money? SEBI recently disclosed some data saying that 93% of people who invest in options lose money. Chances are you are amongst that 93%. And the point is that many times now we in the financial sector are taking advice, or the equivalent of what we are doing in terms of who we take advice from is we are actually taking marriage advice from divorcees. Many of the YouTube influencers who are dishing out trading advice themselves don't make any money in trading. SEBI recently caught some people recently. They make more money in courses and they were fudging their trading data completely. This book is something which I picked up about 15 years back, and it has changed my approach towards investing. Warren Buffett, and the point we are talking about is that if you had to take a view of how to make money on the stock market, you would obviously take the opinion of somebody who is already making money on the stock market. Now, who are the people who have made the maximum money on the stock market over a greater than 10-year time frame? There are only two people who have returned figures of 23% or more. One of them is Warren Buffett, and the second one is Peter Lynch. Peter Lynch was the fund manager at Fidelity Magellan. He has written an excellent book called One Up on Wall Street, and Buffettology was written by his former daughter-in-law, Mary Buffett, who has articulated in extremely simple terms how Warren Buffett approaches stock market investing. Um, I started following these principles a long time back, and we made a huge amount of money on the stock market. In this book, I am going to detail out the basic principles on which Warren Buffett's approach to investing, called value investing, is, and having a concept of margin of safety is completely different from the other 99% of the people out there who are primarily momentum investors. I'm Maneesh Konkar. I am a corporate trainer and a digital marketing agency. We also have online courses in sales, marketing, and leadership. Finance is our favorite subject, and we do believe that if you manage your money properly, you can live much more fulfilling lives. Money is not, is a concept for us which should improve our lifestyle, and investing in stocks becomes a great way to do that. Please understand that this is not stock market advice. We're not giving any recommendation on which stock to buy in the current market scenario. Please do your own research. Buffett has some fantastic tools by which he enables us to do this. And until you have read at least 10 books on Buffettology, on how Warren Buffett goes about investing stocks, please do not invest a single naya paisa in the stock market. Okay. Having said that, I would like to talk about this book that has changed our basic approach towards stock market investing. I'm going to talk about 9 investing tips that you can take up. Investing Secrets by Warren Buffett. Please use your own wisdom to apply these concepts in whatever investments you are doing. The first one that Warren Buffett talks about is something called circle of competence. What he's basically saying is buy into a stock only if you understand the underlying business. For example, we do a lot of work with the automobile industry. I do a lot of work with FMCG. I am an ex-ITC person, and we worked with over half of the FMCG companies in India. I understand that business. And if you ask me how does an AI business work, I have no idea. If you ask me how does a fintech work, I have literally no idea. We have done work with ICICI and Citibank once upon a time, and and yeah, a few companies of the Bajaj Finance Group. We've done some training there, but do we understand the financial sector as well as we understand automobiles? Not really, right? So, circle of competence is the first thing that we're talking about. Is invest in stocks whose underlying business is something that you understand. That's your circle of competence. Do not stray outside of it. We have this concept called right to win. Right to win is only in your circle of competence. Only if you are good at it is where you are likely to succeed. And if you understand the business, then you can take a call on whether the inputs that you are getting from the media are actually biased or unbiased. I mean, they're going to be biased in most cases, but is that a bias that you are comfortable with? So that's the first point, circle of competence. The second basic concept that Warren Buffett talks about is that you are not buying a stock, you are buying a fractional ownership of a business. And the idea is that this business is, it keeps going through ups and downs. Every day the business, any business buys raw material, hires people, puts them up into offices, buys computers, and does some work, adds value to that raw material and sends it and sells it in the market. Most of the good ones do it at a very high profit margin. They get good returns on equity and return on capital employed. So a great business is something which produces consistent earnings over a period of time. It has strong brands. It is what Buffett calls a strong moat. A moat is from the erstwhile Roman days. It's a castle. Castle has a moat, and the moat protects the castle from enemy invaders. So a good business is a business which has a very powerful moat. And Buffett in his book talks about different ways in which you can define this moat. For example, Coca-Cola has a moat which is a very strong brand. Nike has a moat which is a very strong brand. It has a very high brand recall. So does American Express. So the idea is to study the underlying business and look for consistency in earnings, look for strong brands, look for high return on equity. He lists out a few financial ratios. That's the second thing that you look at, is you buy into great businesses. The third point that he talks about is playing around with your own, understanding your own emotions. And stock market investing, what do people do? Is people tend to buy when the stock market is up. They get very excited over it, and then they get depressed when the stock market is down. And many times, while theoretically you will know that buying low and selling high is the way to make money, most of us do the exact opposite. Most of us buy when it is high and sell when it is low. The market goes through a cycle of euphoria to fear and back to euphoria. The idea that he talks about is that you be fearful when others are greedy. When everyone's telling you to buy stocks, chances are that they are wrong. Chances are that they're getting carried away with enthusiasm and euphoria. And right now, for example, the stock market is fearful, and that is when you should be greedy. During times of political uncertainty, the uncertainty caused by Donald Trump's tariffs is the time when a lot of stocks are available at very, very economical prices, and therefore be fearful when others are greedy and be greedy when others are fearful. That's his third concept. Okay. Point number four is Warren Buffett doesn't invest in IPOs at all. He calls them, it's probably overpriced. IPOs tend to be marketed. The merchant bankers, the brokers in the financial community tend to invest a lot of money in hyping up the price of a particular stock. And the IPO is usually a very well marketed event. There's a demand that is created for that stock, and Warren Buffett does not believe in IPOs at all. Okay. Point number five, the next point, he talks about a concept called Mr. Market. So, what is Mr. Market? He says, as we've already seen, he talks about buying a stock, which is a fractional ownership of a business, and there is this underlying business. Now, the business is going through ups and downs. This business faces fluctuating raw materials, it faces a competitive market, it faces government regulations, and a lot of these factors, hundreds of these factors come together to define that business. Now, there is some story happening in that business, but there is another story many times that is happening on the stock market. So he has this concept called Mr. Market. What is Mr. Market? Mr. Market is somebody who quotes a selling price to you. For example, if you look at HUL stock right now, Mr. Market quotes a particular price. He keeps changing that quote every now and then. Today he will come and give you a quote. 1 minute later the quote will be different, and 1 month later the quote will be different. 1 year later the quote will be different. It may be higher or lower, but Mr. Market is the one who is different from the business, the underlying business. Now what you and I have to do is that you evaluate the underlying business and arrive at a fair price, what he calls intrinsic value. And this you compare to the price that is being quoted. And then what do? You have a price that is being quoted which is lower than the intrinsic value. It's a good buy. That is when you should buy that stock. You have a price that is being quoted which is much higher than the intrinsic value, then your margin of safety is much lower, and therefore your probability of making money is much lower. Okay? Capital protection, protecting the principal, is one of the key points of long-term wealth creation, which is what he talks about when he says this concept of Mr. Market. Point number six. Okay, now in this book, what Mary Buffett talks about is two approaches. There is a quantitative aspect of investing, and there's a qualitative aspect of investing. Qualitative is the opinion, the emotion that you are holding. Quantitative aspect is the underlying numbers. Now we've been talking about the qualitative aspect till now. Let's now spend a little time talking about the quantitative aspects also. So the quantitative aspect of Buffett's style of investing, Buffettology, is that while you are buying a fractional ownership of a stock, would you be interested in buying the full business at that particular price? So the parameter that he uses is price earnings multiple. So what is price earnings multiple? Supposing a company is quoting at a market capitalization of, let's say, 10,000 crores, and it made 2,000 crores in profits. What is the price earnings multiple? Price upon earning 10,000 crore divided by 2,000 crore. It's quoting at a price earnings of 5. Okay. Now, point is, if you had 10,000 crores, would you be interested in buying 100% of this company? And if you bought it at 10,000 crores, which is what Mr. Market is quoting to you right now, then is it a financially good decision? Well, now if you had 2,000 crores, now let's assume that okay, the numbers are huge, of course, and very few people have that kind of money. But let's understand the thinking pattern over here. The thinking pattern is, if you had 10,000 crores, what are the options available to you? You could put them in government in securities. You could put them in, say, PPF, theoretically. I mean, can't put that kind of money in PPF, but let's say you could. And you could put it in a fixed deposit. Now, if you were to put it in a fixed deposit, you would make what, 7.5%, 7%? So if you had 10,000 crores, you would make 7%. Fine. But if you put, and that will be how much? 700 crores. But if you invested in this company which is at a price earnings multiple of 5, then you would be 100% owner of this company. And how much money would you make every month? The money equivalent to the net profit of the company. So you would make 2,000 crores. So 10,000 crores invested in FDs gives you 7%. 10,000 crores invested in this company at this point in time, which is giving you 2,000 crores in net profit. Price earnings multiple 5, 100 upon price earnings multiple 20%. 20%, the inverse of the price earnings multiple, is the question that answers, would you buy the full business at this point in time? So what he says is, his concept is that you compare it to the interest rates at that point in time. And if it is favorable, if the interest rate gets you more money, then this business is being quoted a little too high. You wait for the price to fall, wait for the Mr. Market to offer a different price. Otherwise, your probability of making money in that business is a little lower. The margin of safety is a little lower. You could, of course, make money. No one knows what's going to happen. But what we are talking about is probabilities. What we are talking about is your chances of the margin of safety that is built in. So would you buy the entire business? 100 upon price earnings multiple needs to be greater than the interest rate. And that's the formula, which is the quant side of the story. A second side of the story is the comparison of the market capitalization of the company to the book value. Occasionally, you will find that the market cap is even less than the book value. What that makes a business a great buy at that point in time. How? What is book value? Now, we have been taught in finance that book value is the sum total of the financial assets, the physical assets of the company. Okay? It's a different way of looking at it. It is the price, it is the value of the business when it is dead. If a business were to shut down today, what would the shareholders get? They would get the value of the plant and machinery. They would get the value of the land. They would get the value of the fixed deposits and the financial balance, the cash balances that the money is there. And maybe there's some plant and machinery which is depreciated. It could be sold in the market. All of this amounts to book value. Now, sometimes you've got a book value of 10,000 crores and you'll find the market capitalization is 8,000 crores. And therefore, what you have a running business which is quoting at less than book value. And if a running business is quoting at less than book value, what does that mean? It means the business, the book is 10,000 crores. The market capitalization is 8,000 crores. If a company has a market cap of less than book value, it means the running business is being quoted at zero, in fact negative. How silly can that be? You will find right now, go check out in the market on the number of companies in the top 500 companies in the stock market which are quoting at less than book value. You'll find some of the bargains. This is one of the indicators. This is not the only indicator, of course. Okay. Till you read this book, my purpose of sharing these concepts is that all of this gives you a short list of companies to work for. Check out the oil companies and the commodity players, the steel players, and you will find price to book values keep varying. Sometimes it goes above one, sometimes it goes below one. Those become great opportunities to buy from Warren Buffett's point of view. So, point number 7, check price to book value on the quant side. So, basically, what we're talking about is that you are buying an underlying business which is going through temporary trouble. Now, this temporary trouble could be either an industry-wide phenomena or it could be a company phenomena. There's something gone wrong with the company. For example, the company is facing a lot of competitive intensity. Entire industry trouble right now, for example, FMCG is going through a lot of challenges. If oil prices go high, then the airlines face a lot of challenges. Buffett doesn't believe in buying into airlines. I'm giving this as an example of an industry-wide challenge. If the cost of raw material goes up for an entire sector, then, for example, if the cost of sugar goes up, then all the companies which are making chocolates will see a rise in their raw material prices and therefore a pressure on profitability. So the idea is to buy into great businesses which are going through temporary trouble. Now, what is temporary trouble? Well, it depends on your research, on what it produces, on whether that trouble is temporary or not. So Coca-Cola, for example, is facing a competition from Reliance Campa right now. It's facing a little bit of a challenge in terms of needing to drop its prices. Now, your call on whether the challenge is. So one question to ask is Coca-Cola a good company to buy right now? Well, go look at the numbers. You'll get your answer over there. Second point is it going through temporary trouble or is this permanent trouble? Is Reliance Campa temporary challenge to profitability or is it something else? So buy into great businesses going through temporary trouble. And the last point, therefore, very critical. One does not buy blindly in the stock market because the rate at which you buy determines your rate of return. You are your profit, the biggest indicator of the profit that you will make is the rate at which you will buy stock market. All right. Having said that, everybody, I strongly urge you to go and pick up this book. We make no commission out of this. You can buy it on Flipkart, you can buy it on Amazon. This is the book that we are talking about. It's one of the best and the simplest books on Warren Buffett's philosophy of investing. We are great fans of it. There is also you can also go through something called letters to the shareholder. Buffett writes a long letter, 50-60 pages, which is there on the Berkshire Hathaway site. And have a look at the last 10 years. He actually predicted the 2008 crisis before it happened. It's a Bible. There's a reason why he's called the Oracle of Omaha, and he's one of the greatest investors that the world has known. I'm Maneesh Konkar, great fan of Warren Buffett for many years now, and touch wood, with God's grace, we've learned a lot from him, and it has proven financially beneficial to us also. Have a look at the book, and I will see you on the other side. This is Maneesh Konkar signing off. See you in the next video.